Okay, good morning, everyone. Welcome to the Endorphin Wealth webinar for this quarter. So yeah, not long ago, about 3 or 4 months ago, we had our last webinar for our clients, which was very topical, We had plenty of things happening back then. There was the US election. There was also the height of COVID around the world. So it was a great webinar that we had then in partnership with Oreana, who helped deliver some of our investment solutions for our clients, and they're helping support this webinar again today. So that's fantastic. My name is Rowan Gorringe. I'm here at the Endorphin Wealth offices here in Melbourne, and it's great to have our clients and business partners joining us today for another webinar. And today we've got two absolutely fantastic investment professionals coming along to spend some time with our clients and help you hear about how professionals are managing client money at this time. I'm sure you'll get plenty of value from it, and we'd be really keen for your feedback through your advisors in due course. Just in terms of some protocols for today, you'll notice that the attendees are muted and also your videos are off. We do that just to help run an efficient webinar, but we still certainly value your feedback. So you do have the chat function available if you have any questions on the way through. Just to let everyone know, the webinar will be recorded because, lunchtime on a Friday, not everyone can attend at this time. We get a lot of requests from our clients to get a copy of the recording, and we'll certainly be doing that after today's webinar, and we'll get that out to our network, our clients. Q&A today, we'll see how we go. We don't have a lot of time, but certainly feel free to drop any questions through on the chat. And if we get time at the end, we'll see how we go. But certainly, if not, we can answer any of your questions through your advisors or through myself later on. So let's roll into it. So as mentioned, we've got two presenters today. The first one will be Chris Adams from Pendal. And I'll just give you a little bit of background on Pendal. They're an independent global investment management business focused on delivering superior returns for their clients, with about $97.4 billion under management. Pendal is one of Australia's largest investment managers. And then in terms of Chris, drawing on over 20 years experience in global equities, Chris Adams provides key insights from Pendal Group's investment teams across Australia and international equities. Prior to joining Pendal in 2014, he spent 8 years as a portfolio specialist with BlackRock and HSBC, based in Hong Kong. For the last 7 years, he has been working with Pendal's Australian equity team. So it gives me great pleasure to now hand over to Chris. Thank you, Chris.
Thanks very much, Rowan, and good morning to you all. Thank you all very much for the time that you're taking to listen to what we've got to say around Australian equities. I am going to just share my screen now, and hopefully you can all see that. Really, over the next sort of 20, 25 minutes or so, I really wanted to just take you through our high-level views on how we're seeing Australian equities at the moment, and then specifically how we're building the portfolios to deal with an environment which, still has, we're in a much better place than we certainly were almost literally to the day 12 months ago. But it is an environment still with a lot of uncertainty at the macro level, but also feeding through to individual industries and companies. And so I want to give you some insight into how we're building a portfolio to really account for that kind of environment. But our very high level observation on the Australian equity market at the moment is that we're reasonably constructive. There are a number of things taking place within global capital markets which people are pointing to and saying this is the classic signs of a top, and I'll give you a couple of examples of those. But our view fundamentally is that there are pockets of excess in the markets, but they are a symptom, and an accepted symptom, of a fundamental change in the approach of policymakers, both at a government and central bank level around the world. And really, the fundamental change in their approach to policy is about righting some of the perceived wrongs of the the outcome of the GFC and the policy decisions that were taken there. And what we think that, this new stance that they're taking in terms of fiscal and monetary policy means, very broadly speaking, is a lot of support for equity markets. And again, that is something that we think will be tolerated by policymakers around the world, even if we are seeing, pockets of excess within certain parts of capital markets. So we think this is really, really important to understand. It's why we believe that although there are pockets of excess out there, they don't necessarily mean that we are at a top in terms of equities. But it does mean an additional layer of complexity in terms of managing equities. We think that there have been a number of structural changes that have taken place within economies, and that, that is reflected in the outlook for particular companies and particular industries. And so we think you do need to be very careful in today's market. It's, there's a lot of people talking about just taking a simple view of value versus growth. We think that's too simplistic. We think there is nuance and complexity within that. And as I said, that will sort of lead through to how we're going to construct the portfolio in this environment. So if I give a little bit, put a little bit of meat to the bones of that argument that I've just outlined, the first point that I made was we are seeing pockets of excess, and you do see in media and other commentators sort of talking about what's happening in terms of Bitcoin, in terms of stocks like Tesla. We're seeing it turn up in things like ETFs for things like IPOs, for anything related to sort of renewable energy, and we saw it in a bit of the frenzy that took place in January around GameStop and all the Robin Hood activity. So there are signs of excess in the market and, pockets of speculation. And, I think there's little doubt that some of the money, or perhaps a great deal of the money that's currently being put in the pockets of Americans through their $1,400 stimulus checks, will probably fuel further bouts of this in certain parts of the market. But as I said, our view at the moment is that these are pockets of excess rather than signifying a broader equity market top. You might have heard people concerned about valuations. And again, so what I'm showing you here is the valuation of the American equity market, the S&P 500, versus its long-term history, and then also the Australian market there in orange. Now, there's no doubt we are towards the top of the historical range of valuations. We're not through something that we've never seen before in terms of equity markets. And I think the point that I would make here, if we look at particularly the Australian market in terms of valuations, is that where we go back and we've seen high valuations in the past, we're in quite a different environment now, both in terms of interest rates, which are obviously at very low levels historically, but then also in terms of the earnings recovery that we're coming through, which is helping ease some of the pressure on that valuation multiple. So we look at valuations, they are high by historical standards, but at this point, not at a level where they're concerning us at an aggregate level. Obviously, within markets, there's some dispersion, and you can certainly argue that perhaps some of the growth stocks and momentum stocks that have done well over the last 12 months are at the upper end of valuation ranges. Perhaps there is a little bit too much priced in there, but certainly, there's broad parts of the market where valuations aren't anywhere near as concerning. As I mentioned at the outset, we think that the key factor that people need to be focused on at the moment is this fundamental change in mindset from central banks around the world and governments around the world. If you think back to how policymakers behaved in the wake of the GFC, you might remember all the talk was about austerity and about righting the perceived wrongs of the excesses that built up and led to the GFC. So you had countries very quickly looking to see how they could balance their budgets, imposing austerity, and central banks who were, very, very quick to try to tighten to make sure that, we didn't get sort of any inflationary response to the amount of spending that had taken place. Where we stand today, we believe we're seeing central banks and Fed and governments taking a very different stance. If we look at, the Fed, for example, if we look at the RBA here, they're all signaling that interest rates are likely to remain near zero for an extended period of time. They're talking 2 to 3 years, and the bond market has been testing. They're testing their strength in terms of that stance in recent weeks, but you've seen, the central banks haven't really moved from that. They're saying that interest rates will remain very low, and QE will remain elevated. They're not even thinking about tapering QE. And I think they're very mindful of the tremors that you've seen in markets at points over the last sort of 10 years or so, where they haven't been very careful in terms of signalling how they're going to wind back QE. But they're basically saying that QE remains in place. And at the same time, you've got a huge amount of government spending coming through. And, you know, the fiscal packages in the US that we're seeing, you know, they're almost $2 trillion, which is just been passed through. The infrastructure bill, which is the next big package slated, you know, it's a huge amount of spending coming through. And basically central banks are saying they're going to accommodate that spending. What they're basically telling you is they're going to tolerate a move towards higher inflation. They're going to let the economy run hotter than would have been the case, you know, in the wake of the GFC, for example. The reason they're doing this is because there's a perception that as a result of the approach they took, the GFC, you saw a number of imbalances and, you know, sort of points of stress emerge in the global economy. And a lot of that is around inequality. So, you know, certain parts of society did better in the wake of the GFC than others, and moves to preemptively tighten and reduce fiscal spending, you know, hurt some parts of society more than others. And there's a view that the outcome of things like Brexit, like Trump, you know, even moving to some social unrest around, you know, Black Lives Matter and things like that, there seems to be an awareness of a heightened degree of social stress as a result of inequality. And I think, you know, there's people tracing that back to some of the policy stances that were taken in the wake of the GFC. COVID also highlighted the points of stress that came through in terms of globalized supply chains. You know, companies had optimized their supply chains to the nth degree, so much so that when we did see COVID coming through and disrupting it, you know, that was a huge issue for a lot of companies, a lot of industries. And there seems to be a move from having just-in-time supply chains to just-in-case supply chains, where you have to build in some redundancy to account for things like COVID and those sort of shocks. And then finally, there was a view that, you know, in the wake of the GFC, it was all about restoring global growth. You know, the focus is very much on financial factors. And, you know, there is, again, linked into a lot of those sort of social issues that I spoke about before. There is a view that, you know, perhaps things like the economy, so things like the environment, have been neglected as a result of that. And the upshot of this is, you know, you're seeing central banks talking about things like social equality, about, you know, mental health, clean energy, things that if you went back 10 years ago, you would not have heard central bankers talking about. And we think that reflects this sort of change in sentiment. So what does this mean in effect? And particularly, what does this mean for equities? So first thing you're seeing is a huge increase in money supply. This basically shows you the growth in money supply going back to the early 20s. And you can see we need to go back basically to the wartime era to see money supply growing this strongly. And again, what does this mean? This means a lot of liquidity in markets. It means a lot of things, but specifically for equity markets, it means a lot of liquidity, which is very supportive for equity markets. Second, we're seeing increased tolerance for deficit spending at the government level. And again, this basically shows you the US fiscal surplus and deficit as a percentage of GDP. And again, where we've got to very quickly is that sort of 15% deficit. And really what we've seen here is decades of political thinking and fiscal thinking turn on its head. We had to, you know, go back to sort of an era that came in with Reagan and Thatcher in the early 80s in terms of the focus on balanced budgets. And we're moving away from that now to an environment where governments are more tolerant of deficit spending. And again, this is important because this feeds through to economic growth. This feeds through to corporate earnings growth. So if we look at equity markets at the moment, we think you've got significant structural factors in play here in terms of those policy settings, coupled with the cyclical rebound of what's happening as we come out of COVID. You've got excess savings which have been pent up during that COVID period. You've got the vaccine rollout, so people are now, you know, beginning to, particularly in the US, obviously beginning to get out and have different avenues to be spending their money. And so we think you've got an enormously powerful combination, which is good both for market liquidity and for earnings growth. And that's sort of basically at the heart of our thesis that, you know, this is very, very supportive environment for equity markets. So rather than believing we're at a top in terms of equities because you are seeing these pockets of excess in certain parts of markets. You know, our base case is that you do see equity markets climb higher from here over the rest of the year. We're seeing, you know, another degree of support coming through in terms of inflows into equity markets. And if you sort of club together inflows in ETFs and also mutual funds on a global basis, you can see that actually we were seeing net outflows from global equity markets really for a couple of years now. That has turned around, you know, in the last couple of quarters. And again, we think this is an outcome of a lot of those things that I've just been speaking about. That blue line there is sort of the net flows between ETFs and mutual funds. And you can see that we've climbed back into positive territory for the first time really since early 2019. So there is, as I said, a lot of liquidity in the system. There's a lot of money looking for a home. And if you think about the return that you can get from interest rates, the return that you can get from bond yields, it isn't very much at the moment. So we think a lot of this money is being forced into equity markets. And again, this is another supportive factor. As I mentioned, though, there is a degree of complexity taking place behind this sort of broadly supportive market. And a lot of this is to do with what we're seeing in bond yields. Now, this is quite a technical slide, so I'm not going to go into too much detail. But basically what we're seeing is a broad shift in terms of bond yields and in the drivers of bond yields, which have implications for what's going to do best in equity markets. And we think you're moving into an environment where market leadership is changing. We've been in an environment really for several years now where growth stocks have done well. So this is healthcare, this is technology, and a large part of that has been because bond yields have been falling. We've moved into an environment now where bond yields are increasing. Now, we think there is a limit to how much they can increase before central banks will act to sort of limit that. But we've moved away from that environment of just, you know, persistently falling bond yields. And there's different parts of that. There's inflation expectations, there's expectations around moves in nominal interest rates. But the key factors to draw out here is that this is good for cyclical stocks, which are often driven by inflation expectations, which are part of bond yields. It's also good for financials because nominal bond yields are tied very closely to their margins. And it's not as good for growth stocks. So some of those technology companies, some of those healthcare companies no longer have the tailwinds which have propelled them over the last few years. Now, again, we're not advocating taking a very simplistic view of sort of buy value, buy cyclicals, sell growth. There is a lot of nuance in there. You're starting to see a dispersion within growth companies, for example, between those that are actually profitable and, you know, delivering cash flow and those which are highly speculative. You know, they moved in lockstep for some time. They're now starting to diverge and people really are focusing on that cash. Likewise, there are a number of, you know, value companies which, as a result of what's happened recently, but then also longer term factors, they're structurally challenged and they're cheap for a reason. So there is a lot of nuance and complexity there. But we think it's an important point to make that you are seeing leadership change within markets, and what drives equity markets from here, we think will look quite different to what has taken place in the years previously. And we think this is actually good for Australia within the context of global markets. And if you look at the makeup of the Australian market, you know, we're heavy in things like financials, we're heavy in things like cyclicals, like resources. And as I said, you know, there's a number of factors combining now which make those parts of the market look more attractive and have more sort of fundamental support. And we don't have as many tech companies. And that's what this chart is showing you, basically, the composition or the proportion of the equity market, which is made up of tech. And you can see in Australia, it's only about 5%. If you go to places like the US, you're sort of getting up to sort of 35, 40%. And a lot of this, we think, is, you know, driven the disparity in performance. Australia has been a laggard in terms of its equity market for several years. And we think now that, you know, that is starting to turn around. And that Australia actually looks reasonably well placed from that perspective. Just in terms of touching on resources, you know, it is a big part of the market. We think that looks pretty good. The banks also look pretty good. And a key part of, you know, the story behind banks at the moment is that, again, their behaviour was very different to what we saw in the GFC. In the GFC, they were probably a bit late to raise provisions against the threat of bad and doubtful debts that came out of that. This time, they were very quick. And that's what the chart is showing you there on the left. The blue bars are their reserves, and you can see that they moved very quickly in 2020 to increase their reserves substantially. But the outcome in terms of bad debts, which is what that black line is showing, it was actually being reasonably benign. So banks are sitting with a lot of excess capital on their balance sheets at the moment. It means they've been able to resume dividends. It also means that, some of that capital is probably likely to find its way back into shareholders. So we think things are looking good for the banks, as well as bond yields lifting, which is good for their margins. And within banks, we actually think Westpac looks pretty well set because it's got more to do in terms of cost. It's got, the more bloated cost base. So it has, greater scope to reduce costs, and management are certainly making, signals that that's what they're going to be looking to do. So within banks, Westpac's probably our preferred one. And then resources. Resources are also in a sweet spot. They're a sector, particularly the iron ore sector, which obviously did very well during COVID on the back of the policy stimulus coming out of China. And the interesting thing about the resource companies at the moment is the degree of discipline that they're showing. So I'm showing you here their earnings in blue, and you can see that surge that's happened recently on the back of high iron ore prices. That yellow line is their CapEx. That's them investing in new production. And you can see that, this has been a sector which has been sort of, known in the past for very poor CapEx discipline and blowing money on all sorts of projects. This time around, they're being very, very disciplined. So what this means is a lot more cash flow is finding its way back into shareholders' pockets. So we think that resources looks pretty good. Now, really, if you've got banks doing well and you've got resources doing well, that's pretty good for the Australian market. And we've got to go back a long time to really find an environment in which both those large parts of the Australian market were doing well at the same time. But we think we're in that environment now. Now, when it comes to building the portfolio, as I said, that's just sort of a couple of high-level observations of the market. The way we go about building portfolios is not really to try to make a binary call on what we think the outcome of the macro is going to be, whether or not that's around policy, whether or not that's around what happens with COVID. And, there are still some risks there with the vaccination programs, racing in against new strains of the virus, growth versus value, all these sort of big macro events. We're not trying to make a binary call on that. What we try to do is build a portfolio with different kinds of stocks in it. The companies that we're selecting because they've got their own sort of fundamental story as well, but they also play a very important role in the portfolio. So different kinds of companies that we're looking at the moment. For all that I've said, that, policy remains very, very supportive at the moment, and governments and central banks are making all the right kind of noises about keeping monetary policy loose and keeping spending. That could change. If we did see inflationary pressure coming through faster than they're assuming, for example, we could see a change in policy. We could see some tightening coming through there. It's not our base case, but we need to account for that risk in the portfolio. So we do have some more defensive companies which would do well in that environment. We do expect inflation to be picking up, and we're seeing that particularly in areas like commodities at the moment. So you do need to have a healthy proportion of companies which have that pricing power and will benefit from that environment. You are seeing, companies where they've emerged, if anything, from COVID. They maybe saw a short-term hit, but they've emerged, if anything, in an even stronger competitive positioning. And now they're benefiting from a pickup in demand, that pent-up demand. And so we've got those kind of companies in there as well. And then you've got companies which were extremely heavily impacted by COVID. These ones where we had to do a lot of work, this time last year to make sure they had the liquidity and balance sheet strength to weather an extended period of disruption, but which are now seeing the tailwinds as economies are opening up. So there's some of the different kinds of companies we've got in the portfolio. To give you a little bit of detail about what that looks like, these are some of the companies, not all of the companies, these are some of the key companies we've got in the portfolio at the moment. So as I mentioned, you've got your defensives there. Evolution is a gold miner, Amcor packaging company. And these are there really, and likewise with some of those growth companies, that if we do see that reversal in policy, if we see things starting to tighten, if we do see, bond yields coming down, these will be the kind of companies which can do well in that kind of environment. But as I said, this isn't so much a call on the macro. There is also a fundamental reason, for owning each of these companies that we think, provide some share price support. Evolution's got some interesting things happening in terms of recent acquisition of mines in Canada, which can grow earnings there. likewise, Telstra is another one that sits in this bucket, where it'd be a defensive exposure if the markets do have a downturn. But we also think the market is underestimating the degree of earning strength that's going to come through there as pricing turns in the mobile phone market and, as the impact of their cost out comes through. We've then got some of those companies which should do well as inflation picks up. Companies like BHP, Santos, Metcash is another one there. And, Metcash through its IGA franchise is another one where there's a lot happening on the fundamental side as well in terms of the market share it's been able to take as a result of COVID. And then some of those franchise winners. So, companies like James Hardie, which is doing really well on the back of strength in US housing. At the same time, it's been able to regain market share from its competitors. You've got Nine, where this was a company which saw a huge impact on its advertising revenues as a result of COVID, but it was able to move quickly to take out a lot of costs. It's seen benefits come through in areas of its business like Stan. So it's made a structural change to its cost base. And at the same time, you're now seeing a return of that advertising revenue. And we think the next couple of quarters are going to be very strong there off a lower cost base. So Nine was one of those companies where you had to move quickly to make sure that its balance sheet strength and liquidity was such that it could weather an extended downturn. But, that was one of the great investing opportunities that came out of COVID. And likewise, Aristocrat's in that bucket as well. And then you've got the companies which saw, a big impact from COVID. And again, we're able to weather that and are now seeing, a return of demand. And we're expecting to see a greater return of demand and, a return of revenue as a result of what's happening with the economic reopen. And, Qantas is a great example of that. Again, it's been a company that's been able to basically restructure itself as a result of COVID and take out a lot of costs. There is still a lot of uncertainty over whether its international business or when its international business comes back. But it's a company now which is, its break even for cash flow is far lower than it was previously. And for it, it's all about the domestic demand coming back. It's a far larger and far more profitable part of its business. And again, indications here are very, very strong. You're going to get a lot of, as reopening happens in Australia, there's a lot of pent-up travel demand, which will feed through into Qantas, we think. So that, again, is a very attractive opportunity in this environment. That's pretty much all I had to say. I realise that I've covered a lot there. I think, just to recap, as I said, there are pockets of excess which are being highlighted in the media at the moment. As I said, it's Bitcoin, it's Tesla, it's concept stocks and things like that. We think these are pockets of excess. Valuations at an aggregate level for equity markets, we think look okay in the current environment, given where interest rates are. And as I said, our base case is that equity markets do continue to go up from here, not at the same pace that they've gone up for the last sort of 6 to 9 months, but we think there's a lot of supportive factors there. The key one being this fundamental change in the mindset of policymakers, and we think it's really hard to understate the importance of that. The way they are approaching this crisis is very different from the way they approached the GFC, and we think that's enormously supportive for equity markets. But within equity markets, as I said, there's a greater degree of complexity. There are structural changes that have taken place. Leadership is changing, but it's not just a simplistic matter of selling your growth stocks and buying your value stocks, because we think that there is still that risk of policy changing out there. You need to have all different kinds of stocks in your portfolio, but you need to have stocks which are well set fundamentally for the current environment, and that's what we're trying to identify and put in the portfolio. So with that, I thank you very much for your time, and I'll hand you back to Ron.
Thank you, Chris. Thank you so much. Amazing. Great perspective there that you've provided us. And I love the point you made is that the market is very nuanced. And so having, the diversification that you've got across multiple scenarios really struck a chord with me, and the benefits of having professional fund managers like yourself with your hands on the wheel. Fantastic. So thank you for that. And so now, pleasure to hand over to T.Rowe Price, and we've got Sam, and I'll just give you a little bit of background about T.Rowe Price. They're an independent investment management company also, and they're focused on helping clients meet their objectives and achieve their long-term goals. Their global client base includes many of the world's leading corporations, foundations, and financial intermediaries. Sam is also a portfolio specialist, like Chris, in the equity division of T.Rowe Price, and he's vice president also of T.Rowe Price Australia, and holds a Bachelor of Applied Finance from the University of South Australia. His investment experience began in 2008 and has been with T.Rowe Price since 2020. Prior to this, he was employed by Macquarie Investment Management. And with that, pleasure to hand over to Sam. Thanks, Sam.
Thank you. Pleasure to be here. I'll take a quick moment to share my screen, and hopefully all of this works well. Is that all coming fine? Okay, great. I probably should have exchanged some notes with Chris, because there's a lot of similarities in terms of some of our views and some of our observations on markets. And in some ways, 20 or 25 minutes to cover one of the most dynamic periods we've seen globally and in markets is a tall order. But if we think about some of the key points, looking back and looking forward, for us, obviously needing to take stock of the huge human impact, and I don't want to discredit that by just purely focusing on the financials here and the economics of what we experienced. What I really want to go through is the good, the bad, and the ugly, and I'll explain what they are. And upon reflection, in terms of these three broad categories, I wish I could have added the good, the bad, the ugly, and who knows, because I think right now when we think about the future, we are very much being humble about the fact that we really cannot have precise view on how this world gets back to normal. And we think about normal, for us in inverted commas, it's more the new normal. So there's a huge margin for error here in terms of where you place our clients' capital, in terms of what will benefit as this world gets back to normal, and what that looks like, as well as how fast. Thankfully, on our side, in terms of the resource we have looking at this, we've got 200 analysts based globally that are all individually looking in their very specific pocket of the world, whether it be in healthcare, financials, cyclicals, or as Chris put it, the value versus growth, and just trying to, at the very moment we see the most upside, throw these ideas up to the portfolio manager for consideration. So the good, the bad, the ugly, the who knows for us really starts with the good. And despite what we saw in 2020 being a record recession for the world, which is quite amazing when you look at what markets have done, despite us seeing a record sell-off in markets in a matter of weeks, there's a lot of good in terms of some of the companies that benefited here. And when we think back, it's quite obvious for us in hindsight, it wasn't obvious at the time, to think about how this event was actually going to be the catalyst for the simultaneous shift in behaviours of the global population. So 8 billion people at once being locked down at home, not entire lockdown across the world, but this really was a catalyst for a dramatic shift in spending and for a dramatic shift in behaviour. And on the left-hand side, what you can see here last year in terms of comparing the year-over-year credit card spending, you can see how dramatic that shift was. We weren't able to go to sporting matches, to go to cinemas, to really consume outside entertainment. And we can see that entertainment services broadly. This is for the US consumer, just to highlight, that was down more than 80%. And on the other extreme, we saw that an immense amount of our budgets was shifted to consuming online. That's predominantly online retail spend, but as we all know, and I'm probably hashing over things that are quite obvious to everyone on this call, that obviously meant that a lot more people had to shop online or had a preference to shop online, ordering more takeout online on whatever app you might use, consuming more Netflix, etc. This had a dramatic shift in the market in terms of which companies did well and which companies did badly. And one of the most phenomenal statistics that we've seen that came out of 2020 was actually that step change we saw in terms of e-commerce penetration. So we think about what happened over a decade from 2008 to 2019. We had a 10 percentage point increase from 6 to 16%. That jump we saw there from 16% to 26% happened in a short space of 10 weeks. So to show how extreme COVID was, we saw 10 years of change happen in just a 10-week period for, not for markets, but for in terms of how companies actually benefit from this. And I won't touch on this too much because it's pretty much revisiting exactly what Chris touched on. But the reason why markets did better was not just because some companies benefited from that behavioural shift, but the response from central banks and governments was enormously different. And we can just see a side-by-side comparison there, which it was all about financial security and austerity in the prior crisis. In this crisis, this wasn't actually a recession that was created by the financial system. And given that the banks predominantly had recapitalised, had much better standards for lending versus 2008, it actually enabled us to avoid a credit cycle. So all this stimulus that flooded into markets, all this extra cash that flooded into the back pocket of the consumer or households, even for corporates. So the fact that a lot of these corporates, Chris mentioned balance sheets, and that was a very strong risk back in March. The fact that the credit markets were significantly reopened is something that really meant that a lot of these companies were able to refinance and weather the storm, and are now in that position where it's all about what's their cyclical recovery going to be. Hence why there is this really big, I'd call it an agitation in markets right now, trying to understand if we've had such extreme winners and extreme losers in terms of the companies you want to invest in 2020, at what point does that snap back? For us, that's not a very clear line, and we've heard the word nuanced, and I'll run through some of our thoughts in a moment in terms of how we're thinking through that. That level of stimulus, again, very similar slide to what we've already seen, but this just shows the extent. This is very US focused because we are a more global focused investment strategy, investing all around the world. But in terms of the Fed's balance sheet, so the US Federal Reserve, this is really, we hear this term money printing on the left-hand side. This is a representation of how much additional money has been printed to stimulate the economy. And we can see there that it is at a huge margin to what we saw back in war times, but now even back towards the GFC. As a comparison, it is enormous, the contrast here. We saw in a number of months more stimulus than we saw in a number of years as a response to the GFC. So central banks, governments really reacted quickly. And that's why, as we'll see in a moment, equity markets have been incredibly resilient as all this money has, or not all of it, but a lot of it has actually flooded back towards equity markets. So as we take stock of what some of these returns have been, we can see here ranked left to right, just some of, for comparison, the one-year returns we've seen for some of these share markets. I will point out that the majority of these are in USD, if not in their local currency, just because the extreme move in the US to Australian dollar does have a big impact. And this really, by keeping it in US dollars, shows how the local markets outside of currency moves have really responded. So what we can see here is point to point, when we really think about even from the depths of the crisis, share markets have actually been incredibly resilient. Global equities, in terms of just incorporating all countries around the world, is that middle bar, so MSCI All Country World Index. It's astonishing that even when we take into account the falls, that market's up 18, 19% from the peak point before the market originally fell. So investors have done very well by staying invested, and it's really just an incredible sign of how resilient markets have been. But when we look at this, there is also a very stark contrast between some of the winners and losers. So Australian market, which we've heard pointed out, a much more cyclically exposed country, didn't do as well when it was a lot of the more online disruptive businesses doing well. We also agree that Australia is quite well positioned now as we rotate back more towards a reopening or a recovery. But even if we think about within some of these indexes, on the far left, we can see emerging markets being one of the strongest performers over that 12-month period, a very large portion of that being China, which went into COVID first, but came out of it very, very quickly and very strongly. So that one-year return for China was actually just shy of 50% in terms of what we could have generated just in that one country alone. But then even if we just break it down a little bit more within the S&P 500, which is a great representation of the US, there was a very stark contrast or dispersion between which sectors were your winners or your losers. So IT, which was very much exposed to the world going online or taking businesses to the cloud as people were needing to work from home, was a very strong outperformer. So IT as a US subsector was actually up more than 50% in that period as well. But overall, it's encouraging to see that all this stimulus, and this is the good, when I said the good, bad, and the ugly, all this stimulus has actually been strong for asset prices, strong for investors, and over a one-year period, despite the huge fall in markets initially, and despite a huge fall in terms of GDP globally, that investors have done quite well. So on the back of this, I think it's good to just have an example of how did some of these companies do so well in what was such an unprecedented contraction. And one example here is a company you may not have heard of before, but they're exposed to three of what we would say are the most exciting themes globally in terms of a company's digital presence. So C is actually, it's probably best thought of as a combination between Amazon or Alibaba in terms of their e-commerce exposure, but then also online mobile gaming, which you may have heard of, the Chinese company Tencent, which does this as well. What we really like about C is this is a little known company. It's more known now, but this is a company that was up around 500% in 2020. It's a company we've held since IPO, and it's made, I think, around 15 times within our portfolio since we've held it. But they're addressing an incredibly large market. So they're predominantly in Southeast Asia. So it's a population. So their potential customer base is around 700 million people, which is a very large pond to fish in. But it's also incredibly underpenetrated. What I mean by that, people think about China as an incredible opportunity for buying some of these digital businesses. They think about e-commerce in China being only about 20% penetrated. This is post-COVID, obviously, sorry, pre-COVID. So during COVID, this actually changed a little bit. But when we think about Southeast Asia, they're much more early in terms of that step change or getting into consuming online. So it's only around about 5% of the population is actually consuming e-commerce, and that's a really large market for this company to start to penetrate as the #1 e-commerce company in that region. They've also got very strong exposure to mobile gaming. So this is actually people downloading an app on their phone and hopefully down the track paying more to use that. So they've got a key hit game called Free Fire. This is one where you might play with people around the world, but you also, when you're in the game, you have to make certain purchases within that game to get forward into different levels and to improve your status as well. To give you a context of, for many people that don't do mobile gaming, how incredible this can be in terms of a revenue driver, we're expecting that next year alone, this company can drive about US $5.5 billion of revenue alone just from that mobile gaming segment. When we think about the e-commerce opportunity, this is something where back in 2010, C, so this company C, had $0 from e-commerce sales. And just at the close of 2020, they've now reported $12 billion of sales in just that short 5 or 6 year period. This is very much, though, still just a fraction of the total opportunity. So by 2025, we actually expect that the total e-commerce opportunity in terms of dollars spent in the region could be somewhere around $172 billion. They're only currently, as I mentioned, generating $12 billion, and they're the #1 player in that region. So a huge amount to grow. This comes off the back of this company growing sales for the past 5 years at just shy of 80% per annum up until this point. So the company's done really well. But what we saw during COVID was it completely provided that platform or that step change where they could not just accelerate the number of players playing their games, not just accelerate the number of people needing to consume on their e-commerce platform, but it's done one key thing as well, which is actually because they were much better capitalized, it's allowed them to basically confirm themselves as the definite #1 e-commerce player in a market where they previously had about 2 or 3 competitors. So as an example, that just shows how much of a tailwind COVID has provided to some of these companies that were doing well previously, but it's basically cemented their leadership. So that's a lot of the good. When we think about the bad, I won't talk about what Bitcoin's done. Chris had a very similar chart as well, but I couldn't find one of my local bus stop, but there's a sign here, and it's a little bit comical, but you can see on the right here that says, if you're seeing Bitcoin on the underground, it's time to buy. We have locally in Australia, the same company advertising, if you see Bitcoin on a bus or if you see Bitcoin on a bus stop, it's time to buy. For us, this is probably the exact sign of when you don't want to buy into some of this irrational behavior. We heard about GameStop, Bitcoin as well, for all the fact that it's actually a decent inflation hedge if the technology works and is sustainable. There are signs here where we're getting more and more concerned just about some of the risk taking in markets. So all that additional stimulus and money that's flooded into markets has helped equity markets do very, very well. But it's also meant by pushing down rates and yields as well, which has definitely been the aim of central governments around the world. Or central banks. It's also meant that it's pushed risk-taking higher. I even have my colleague next to me behind me who recently said, I'm just going to put a little bit in Bitcoin because it seems like it's too good to miss out on. That type of thinking and behavior is just something that we're very aware of, because it can start to drive some irrational behavior, not just in Bitcoin, not just in companies like GameStop, but even in the broader market. So we're very much focused on this right now. So that was a little bit about the bad, and to transition towards the potential ugly. What we're seeing right now is an enormous acceleration or expected acceleration in terms of how economies accelerate from here and how companies accelerate their earnings from here. That'll be quite nuanced, again, in terms of which companies can further accelerate or re-accelerate into 2021. And you have to be very careful about choosing companies that were just 2020 winners, that maybe it was just a one period of exceptional growth, but that may not be repeated in 2021. But what we can see here on the left-hand side is that as the world does start to accelerate so quickly, we are seeing the bond market basically playing a little bit of a game of chicken with central banks around the world, saying, we know that you're telling us that there won't be any step changes in interest rates or hikes of interest rates in the near term, but we think that inflation is going to be so out of control that you're going to be forced to do that. And in the absence of any definitive talking down or central banks saying that they're going to control the curve more, that's still something that we're seeing play through, and it does have an impact on which companies in markets are actually starting to see changes in terms of what investors are willing to pay. And that's very much because, as we've heard already, these growth stocks, typically, as we heard, IT, healthcare, that have a very long duration of growth ahead of them, are much more sensitive to when these interest rates actually move as well. But what we have here is not just a game of interest rates, and this is where it's not an ugly scenario for the world just yet, but it's something we have to think about going forward, is that this has really accelerated the trend of increasing debt around the world. At the close of 2020 in December, we now have around US $281 trillion in debt. We saw debt to GDP grow globally from about 320% to 355% at the end of the year. And, we think about this in the context of $24 trillion new debt being added to the world. This is in the context of Australia's economy, which is, less than $1.5 trillion. So we're adding multiples of Australia's economy just like that, just printing money, just adding money or debt to the system. And this is something at some point that we have to ask the question, how this gets repaid. Do we just inflate our way out of this? Does this become a problem where, for central banks around the world, we have to control this at some point in time? It may not be this year, it may not be next year, but at some point, this is a scenario we have to plan for and think of, because it could be that ugly scenario for asset prices such as equities. So how are we thinking more broadly around this? Well, we were very positive in 2020 around what does all this stimulus and excess liquidity mean for markets? And we thought that this would avoid a credit cycle, and it would be a very strong period for share markets, which it was. But what we've actually done in our portfolios now is just dialed back some of the risk we were taking in the portfolio to be a lot more neutral and acknowledging the pushes and the pulls that we're currently seeing. So there's a lot of positives. We'd agree that we don't actually think looking at valuations alone are that excessive given where interest rates are. But when we think more broadly, against some of these things that are supportive of markets, there are equal negatives. So we have low interest rates when we think about valuations, which is very supportive. We do have valuations above average though, and some excess sentiment and behavior, which is starting to worry us in pockets. If we think about COVID-19, the vaccines are a huge positive, but there's no one here that can really tell us, will there be some form of mutation in 3, 4, 5 months' time that is going to really, really prevent the cycle here in terms of when the economies get back to normal and when we can unlock and travel again. US politics, it's a very strong positive to us that we've got a functional government. We're clearly seeing Biden be able to affect more stimulus now, as we saw with that $1.9 trillion bill. But on the negative side, we're almost certainly going to see tax hikes for US corporates. Around 50% of the global indices or index for equities is the US. And on our estimates, we think that the tax hikes could actually reduce earnings on average for the S&P 500 by about 10%. So this is a negative we have to be aware of. Thinking about China, we think Biden improves the relationship, most likely, which is a good change from where we've been with Trump. But the tension will certainly still be there, as the two really have quite competing interests. And then finally, when we think about exuberance in markets, and this is probably the most controversial thing that we're thinking about right now, we would make the statement that we do think that we are currently in a bubble for equities. I make that quite bold statement, which most people would say, if you're in a bubble, sell equities. But on one hand, in a bubble, there's a very big difference between being in the early stages of a bubble or the late stages of a bubble. And I'll give you one key quote that probably stands out to me is, back in 1996, we had Alan Greenspan from the US Fed say, we're seeing signs of irrational exuberance. And it wasn't 4 years until after that point that we saw the tech wreck, effectively that tech bubble pop. And there was a lot of upside in equity markets before that point. On the negative side, even though we may be in the early stage here, that the fact that we have to keep our eyes on what that bubble looks like, where the irrational exuberance is, and the signpost for what may actually cause something like that to pop is just a negative enough that's making us, when we combine all of this, reduce some of our risk and just on the margin be a little bit more defensive in the portfolio as we wait for some more signposts around how does this world normalise some of these pushes and pulls, but then when does the world reopen as well. So there's a lot there, but I might hand back now and hopefully that was helpful. But thanks for having me.
Thank you, Sam. Fantastic. And I love the way you put together the good, the bad, and the ugly. And I think, again, it highlights the importance of T.Rowe Price and their kind of global reach. One thing I'd be interested just to provide, if you could, the perspective. You mentioned T.Rowe Price has got 200 analysts/researchers. So just, if you could, for our audience, give a feel for how big the stock universe is globally, and then ultimately through the research team that you've got and your selections, how many stocks do you hold, for example, in one of your flagship portfolios?
Yeah, that's a good question, because the conundrum or the difficulty we have looking at the entire global universe is there's 4,000 companies. And that, when you sort of start with 4,000, is pretty intimidating. But the way that we do this, for your money in our portfolios, is essentially we have very big teams that exclusively cover their one sector quite often for their entire life. So T.Rowe Price, one of the things that we're quite fortunate to have is not just a big team, but a very stable team. So on average, across all of our portfolios, our portfolio managers have been with our firm for 17 years. And what that means is that when you've got someone covering a particular sector, each analyst only focuses on 30 to 40 stocks at one point in time, so they know them intimately. They all have worked with each other so long that it just really creates that debate, and really that information and idea sharing comes through quite strongly. So what does that mean for our portfolio? Is it means that when you come to a point in time where financials or banks have been quite unloved and out of favour for some time, if you're thinking about the potential for an economic reacceleration, a recession that did not turn out to be like the GFC, which people were, if you think back to April, people were predicting record unemployment. I think there were some predictions of Australia heading towards 14-15% unemployment when you adjust for JobKeeper and the rest. This was something where people were basically saying, this is the GFC, sell banks, I don't want them. Very quickly, hopefully this illustration, I'm going on a bit of a tangent here, but when you are thinking about that rule book or the last 5 years of how the market has thought about where to be and where not to be changes, the fact that we've had so many people looking exclusively at 20 or 30 banks the whole way through that cycle, even when they were unloved, just means that it allows us to identify that inflection point much faster. That's why when we think about that change in markets, we were actually investing for this rotation we saw all the way back in April. So we increased our financials exposure by about 10% back then, already seeing that that was the right time. It was a little bit early, but it really helped us out in the fourth quarter.
Fantastic. Excellent, Sam. Much appreciated. Well, look, just checking on the time now. So after Sam's presentation and Chris, we're sort of nearly at time to wrap up. So I think on that note, I will just, again, thank Sam and thank Chris, Chris from Pendal and Sam from T.Rowe Price. And really, just having access to your insights today has been, highly valuable to myself and to our clients and our business partners. So we really do appreciate that. And I think for our clients, it obviously gives you an insight into some of the professional portfolio managers that we do have access to in our Endorphin Wealth diversified portfolios, and having the likes of Sam and Chris in there behind us with our client money is absolutely fantastic. So thank you. So to wrap it up, as mentioned before, we're going to run out of time for questions today. But if you do have any questions, please let your advisor know and we can pick those up later. And as I said before, the webinar has been recorded and we'll distribute that back out to everyone, including some of our clients that make it today. So on that note, I'll wrap up the session and thank all for attending, and you have a great weekend. Thank you.